Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
I want to switch gears and bring in our next two guests, Michael McKee, who's here in studio. He's the international economics and policy correspondent, as we know, with Bloomberg News, and Alyce Andres, who's our U.S. interest rates and FX reporter with Bloomberg News, joining us on Zoom. Mike, I have to start with you and get your take from this morning's jobs print.
Well, it's a pretty good outcome. Put it that way. It depends on where you sit, whether you think it's a good report or not. For the Fed, it's a good report in the sense that it validates their view that unemployment would have to rise to bring down inflation and that their rate increases would put pressure on the labor market. And it does show the labor market is loosening up. Unemployment goes up to 3.8%. 736,000 people joined the labor force. Now, some of that is probable a seasonal adjustment issue, but it does show people coming back into the labor force, which is what the Fed has also been looking for. Now, if you're a worker who's worried about keeping up with inflation with your wages didn't rise as much, 0.2%. Good news on the inflation side, bad news on the keeping up with inflation side. And then those who didn't get jobs or who lost their jobs and the unemployment went up is basically not good news either. So a kind of a mixed report with the numbers, but in terms of the overall macro economy and the Fed outlook, good news.
Alyce, I want to bring you into this conversation. Break down what we're seeing in the bond market reaction to this report.
I think that overall the bond market is viewing this as a weaker report, which was as expected, but not outright weakness. I think that traders are viewing it as a moderation accelerating, but that's exactly what the Fed wants. You know, they want the labor market to come back into better balance. And I think that what the bond market is saying is that this probably puts the majority of the Fed participants on hold. And I think that it also really doesn't take the final hike off of the table, and I think that bond yields are reflecting that today.
Yeah, initially it was at least a 10 basis point drop in the more policy reactive 2-year. We're back to what, down 2 basis points right now, 483. One of the questions I want to ask, did I miss the boat on rates, putting all my money in nice safe treasuries at a really healthy yield?
No. I think you have some time on that. Like I said, I think that people think that the Fed's going to be on hold for a little bit. And, I mean, you know, rates are probably just going to trade a bit of a range, and they're definitely going to be very data dependent. I mean, that's when we're going to see big moves, is on big data days, you know, probably the next one being CPI. And, you know, you'll have your chance, but I think that I think it's pretty clear that the economy is not falling into recession, and I think that rates are going to stay high for a long time. I think that there's been a move in the back end, you know, further out in like June and May Fed funds, and now they're reflecting that the first cut will come in May instead of June. But, you know, it was kind of a small move. I think that the thing that you really got to keep your eye on is the November Fed funds, and they're still pricing a very good chance of another hike coming.
Yeah, we have since it's Friday, we have a drinking game in the studio.
Every
time somebody uses the phrase Goldilocks, we have another shot. Is this Goldilocks, Michael McKee?
Goldilocks, John. Goldilocks.
Thank you.
I want to see you crawl out of here. You could that description is being used on this because it basically is, as she said, slowing, which is what the Fed wants, without crashing. I mean, the economy is still growing, and we're still adding jobs at a pace above the level needed to absorb new entrants to the labor force. So, things are pretty much in a fairy tale world.
One thing I'm curious about, Mike, is July had 2 more weekend days than June. How does that affect the wage print?
It doesn't affect the wage print. It can affect hours worked, but the wages are going to be based on what you're being paid in the week that includes the 12th of the month, the pay period that includes the 12th of the month, which is very complicated because if you get paid once a month, it's the entire month. If you get paid every 2 weeks, it may be just you get into part of it, and sometimes people aren't included at all if you're a freelancer and you get unusual pay periods, which is one reason we did not see the SAG-AFTRA strike show up until this month, because some of those people aren't paid on a regular basis.
Alyce, I know coming into this, you wrote a piece on the team talking about how bonds were at risk for a rally based on what potentially could happen with this August data. How do you view the direction of the bond market, and particularly yields and the 10-year moving forward in the next couple of weeks, to your point, because we do have that September CPI print on the 13th?
Yeah, so I mean, it was a really pretty easy setup for the bond market today. I mean, all the metrics showed, most of them. I think there was two indicators. It was one of the S&P Globals and claims was really the only positive thing for this payroll report. All the other ones were negative. All the Fed reports, all the ISMs, they were all pointing to a weaker report. And so the setup for the bond market was pretty easy. I mean, everybody knew that it was going to rally, and then we were going to sell off right away. That we were going to sell off right after that. And I think that part of it is a function of what we're waiting for on Monday. We're looking for a lot of corporate supply to come into the bond market, and so bond traders are just preparing for that. They're either selling because they're going to take down some of this corporate supply on Tuesday, or you're seeing issuers coming in and rate locking. So that's part of this pullback today in prices and yields going higher. As it moves forward, I think, like I said, we're just going to trade the range. I think that they're going to, bond traders are going to part and parcel every single piece of data. And one of the pieces of data that I thought was pretty interesting was yesterday's Chicago Purchasing Managers report, and they really don't give you a whole lot of information in the report, but what you can glean from it was that new orders and production moved from contraction to expansion, and also employment, I had heard, had a very big uptick, and in fact it did slow. It contracted, but at a slower rate. And so to me, that just really kind of gives the same picture of one that the economy is showing some glimmers of starting to pick up, which is what we've been anticipating, that we're going to see a big pickup starting in the second half, and that's why people are hoarding their labor, and they're just using layoffs as a complete last resort. The other thing that I wanted to say is that on Monday, the Dallas Fed manufacturing report talked about the fact that most participants think that they're going to raise wages at a rate of 5% this year. And so that's far and above inflation and above what we're seeing in average hourly earnings. And so you could get an uptick in inflation based on wages again. And most of the Fed surveys had talked about this year, even recent ones, that they're just going to have to continue to raise wages, first of all, to keep up with the demand that's expected, but also because they can't afford to let go of their labor force, so they're just going to have to raise wages.
Right.
The other thing is on that work week, I thought that was pretty consistent with what we've seen from some of the Fed surveys, that
right.
The uptick in the work week was consistent with, you put your workers to work doing other things on the factory floor or in your shop to keep them busy.
Right.
Mike McKee, final thought in 20 seconds.
Next week, number of Fed speakers.
Yeah, we have a number of Fed speakers. We have John Williams, the New York Fed president, coming in here to Bloomberg, and we'll get their views. But I think this unless we get on the 13th of September a really surprising CPI report, this probably locks in a pause. The Fed does not have to raise. It doesn't make the case for raising at this point.
Right, so John Williams next week, former Fed official Jim Bullard also on the calendar, as well as Susan Collins. So Michael McKee, international economics and policy correspondent with Bloomberg News, and Alyce Andres, U.S. interest rate and FX reporter with Bloomberg News.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Continuing the fun, so I'm glad you gave us an update, obviously, on what's going on with those bond yields, especially when you're looking at the 10-year as well as the 2-year. But who better to break us down when we're looking at what's happening in the fixed income market than Ben Emons, head of fixed income at NewEdge Wealth, who I've known for a long time, joining us to talk to us also about how markets are responding to this latest jobs report. Ben, it's always a pleasure speaking with you. Let's start off with your take on this morning's jobs report and your sort of view on how this could impact the fixed income market ahead of the Fed decision on September 20th.
Hi Jess, hi John. Happy Labor Jobs Day, right?
Thanks for joining us on a quieter day here, heading into the Labor Day weekend.
Yeah, and I'm all casual here. I'm seeing myself streaming live on YouTube, right. And my, casual shirt in California. But let's do it. So I kind of echo Mike McKee's point. Like this is a jobs report where if you're seeing that many people getting pulled into the labor force, which is like 730,000 or so. It tells you that the labor market is quote unquote in demand from people wanting to really get back to work, to try to make more money, and that's good for the economy, right? That's productivity. That's actually a very positive sign. So it is an interesting reaction in the bond market how the number came out. It was sort of in line, the headline, and then people go through the details and see like, yeah, there's loosening of the labor market here. That's what the Fed wants. So the yields on the short end, 2-year go down. But then as we go on a little bit in the session, you see long-term interest rates start to rise a little bit. And there's that ISM data just came out, which was a bit stronger than expected, but the employment component in there too, better than expected, as well as prices paid. You see this shift in the yield curve with long rates going up. And I think you take the payroll support and ISM together, it tells you like, there's not a weakening economy. This is just more people coming into labor force, so looser labor market. What the Fed's looking for. On the other hand, the soft landing, no recession scenario stays in place. And this is why you're getting this steepening of the yield curve on both the shorter end of the yield curve and the longer end. So that's, I think, a very Goldilocks moment.
Goldilocks.
Well, yeah.
Goldilocks.
Ben, about our drinking game here. What is he, the fifth or sixth guest to say Goldilocks
Let's keep a
at
tally.
this point? As far as the inflationary components, how much bargaining power do workers have over employers?
Yeah, they still do, John, because I think that the wage trackers from the Atlanta Fed still show a big difference between those who can quit their job and those who stay in the job, for example, and meaning people quit their job to try to find, better paying jobs. That's still a difference there. You also could think of that the job openings ratio to employment that's still elevated to pre-pandemic. It also indicates, right, that companies are still actively looking for positions to be filled, but all of those metrics have moderated from the real elevated levels. So these strikes that we're talking about and these wage settlements that we're going through currently, it does show that labor is really having control here. Now, the UAW strike actually happens, it would be a negative for the economy. So it does look like they want to try to get bargaining to a better deal. I would point out, though, that if this leads to a real good deal for the workers, there's a little bit of that 70s idea of pattern bargaining, right? One union wins a good agreement, other unions will try to do the same thing. So I think we'll stay a little bit in that dynamic.
One thing I've been thinking a lot about, Ben, is just the 10-year in relation to where the S&P 500 is trading. So say earlier in August, we did see the 10-year peak out around 433. If you looked at where it peaked out back in last autumn, it was around 422. But at that time, the S&P 500 was trading around 3,500. Now it's 1,000 points higher. What's the difference?
I think the difference, one is just the economy in itself, Jess, that at that moment in time, we had much higher inflation and not growing as fast as we do currently. This year turned out to be an economy that's just much better than last year, even though last year still looked like, I guess if you came in early 2022 as a really, boom pandemic economy, but in fact, actually we have a better economy this year. So I think that explains the 1,000 points difference. In addition to that, we obviously have earnings that have not gone into any recession. If anything, they actually showed some bottoming in that fall period and have actually moved up higher, right? And the projections are still higher. That makes that also the difference. And lastly, well, the 10-year topping out at 4.3 and change, just like we had this month, I think it does tell you a story about the disinflation being very successful by the Federal Reserve. both on inflation and now also showing up in the labor data. I think that too expresses itself into this higher stock market, showing that, one, we can keep pricing power. We don't have wages really spiraling out of control. We certainly don't have any recession near term, given the strength of the labor market. So I think that just leads you to this conclusion that you're having a stock market being better because of a better economy.
So what's the level on the 10-year that you're watching to where other asset classes would need to reprice, including the stock market, depending on where it would be headed? Say, would it be 4 or 5?
Yeah, that could be, it's kind of citing my old boss, Bill Gross, like he was the other day on TV, and kind of agree with him. Like, there's still that risk there that you have 4.5 as a level where if you do break that or test that we're getting a different situation, because there's another aspect here happening, that is that the economy is strong because we're investing in the economy with infrastructure and other projects and just business spending itself, but we're also borrowing there for a lot of money, right? And that will continue. That could actually keep rates at least higher or potentially test that level of 4.5. So that we do want to watch, despite we had a little bit of a rally down now from the last high. Just seeing it this morning, the ISM data being just surprisingly a bit stronger, prices paid component goes up a little bit, and the 10-year yield immediately moves up from 4.07 to 4.15. That seems like an intraday move, but it does signify this idea of, it is an economy that stays strong. Be wary of how inflation could return higher again if it stays that strong.
So September, off the table. What's in play at this point for the Federal Reserve?
I think markets have calculated that the Fed needs a bit more time to assess this economy. Therefore, another meeting could be skipped, even though none of the Fed members actually has indicated any of that. By the way, it still seems to be much of a live meeting. Therefore, all the data that we're getting right up to that meeting will count in a decision. But it seems that as we had several data points a bit soft on labor and inflation trending sort of sideways, that there's a possibility that the Fed said, okay, we can skip another meeting to assess a longer period of data and then make our next decision. That seems right, but we got to keep in mind that what's happening in energy markets and what's happening also with China in terms of all its efforts to try to boost its economy in the third, fourth quarter, and our third quarter GDP is actually kicking off better. That I think we have to keep in mind, that the Fed may well use the September meeting to hike after all.
So with the backdrop of all this, how are you advising clients to position in the fixed income market?
So most of this year, Jess, we have been a shorter duration in the index, and that proved to be the right way, because I judged that based upon the economy's resilience and strength. But then you want to, what I say, follow the yield curve. So if it's still an inverted yield curve, if we continue to see this sort of grinding, loosening of the labor market, and this disinflation on inflation front continue, I would think that the yield curve would start to normalize. And so the real good position to be in is that intermediate part of the yield curve. And then ultimately, if we do end up in a situation where unemployment rate is at 4% and inflation is a little lower, then you can extend duration further. So I think the intermediate part of the yield curve, that's what we've been advising to clients.
Hey, Ben, we only have about 30 seconds left. What's the top question you hear from your clients?
Well, how high can rates go and how high do they stay? That's definitely on top of mind, and I think that will continue to be a debate. We don't know how high it will actually go from here. And I think that's an uncertainty going into 2024.
Well, Ben, thanks so much for joining us. Ben Emons, head of fixed income at NewEdge Wealth, joining us on a slower trading day a little bit here.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to get straight to our next guest. I mean, John, you know, we've been talking about the jobs report all morning, but I want to bring in Julia Pollak, who's joining us on Zoom. She's the chief US economist at ZipRecruiter, who's going to break down some of these job numbers. So we've gotten the sort of the surface level take here from the macro side of things, but I wanted to get more of your thoughts when you're looking from an industry level in the job market. What particular corners are holding up better than others at this point?
Sure. So we've seen the job mix sort of shift back to normal, with healthcare and professional business services leading the way. This is an interesting report because it really shows you very clearly what's happening in certain industries. We saw truck transportation lose more than 36,000 jobs. That's largely results of yellow freight that business's closure. We also see signs of the Hollywood strike in this report, with more than 16,000 jobs lost in the movie industry. So, you really get a very granular look in this report at how differently things are playing out in different industries.
Okay, so what does this mean for the path ahead for the Federal Reserve as far as interest rates?
So, I would liken this report to an aircraft sort of cruising at the perfect cruising altitude. If a plane goes too high, you go.
When you say Goldilocks, that's our drinking game. So every time a guest says
We're keeping
that,
a tally,
we take
Julia.
a shot this morning. But
that's
a new metaphor. I like that one too.
Trying to use a new one, exactly. I was worried that perhaps the long and variable lag of monetary policy would start to squeeze too much air out of the room and choke growth. And it doesn't appear that that's happening yet. This labor market appears to be running at a sustainable, solid pace that is not going to fuel inflation, but that is going to continue creating opportunity for workers.
We did see earlier this week, we also had, as you know, the JOLTS data that came out that did show that U.S. job openings did decline to the lowest levels since early 2021. What are you seeing when it comes to some of the quit rates?
Yeah, so this report suggests that Fed Chair Waller was right, that high interest rates would slow the labor market, but that because there was so much excess demand, that slowing would come in the form of falling job openings, not of falling employment. And that's still what we're seeing. The labor market does appear to have come pretty much all the way back to normal. When you look at just sort of the labor market dynamics, the quits rate is all the way back to normal. Online job postings on ZipRecruiter are all the way back to normal. JOLTS openings are still high, but they lag a little bit, and they may also be a little inflated for a number of reasons.
Do you see evidence there of, what do we call it, labor hoarding, where
right,
especially small businesses that had such a difficult time, at least according to the NFIB statistics, finding qualified workers, they're just hanging on to the people that they have right now?
There are a few industries, very unique, peculiar industries, where employers are hoarding labor that is relatively idle. The examples I could give are things like consulting companies, your Bains and McKinseys, with the tech industry entering this year of efficiency. Tech companies are not paying for management consultants to come in and run all kinds of projects for them. And as a result, you have all these Ivy League educated consultants sitting there watching Netflix with very, very few projects to work on. That's a rare case. In normal industries across America, when workers are idle, they get furloughed or laid off. That's not happening in some of these organizations because they worry about the long-term impacts. You don't want to lay off a bunch of Harvard graduates who are going to be future titans of the universe and then shoot yourself in the foot come the next recruiting season. But that's a very unique situation. In most of the country, I would say the country is still understaffed. Go to a restaurant, go to an airport, you'll see lots of check-in counters and very few check-in associates. And so long waits, low customer satisfaction, those are still big problems in the economy. And for the most part, employment levels are below what would be predicted by spending levels and activity levels.
What are you seeing when it comes to temporary employment?
Very interesting. So we've seen a very large drop over the past couple of months since early 2022 in the number of temporary help services employees. Over 200,000 of those jobs have been lost. And that typically is a signal of a recession. It's caused many of the sort of leading economic indexes to suggest that we're in for a big downturn.
So how much of a potential lag would that signal as far as looking ahead to that? Like how far ahead would that signal a potential recession?
Usually it's only about 3 to 4 months ahead, but we've been seeing this indicator decline now for a year and a half. And I would argue that this time is different. The decline is a return to normal. It is a good
because
thing.
Of the pandemic.
Yes. So during the pandemic, companies were so short-staffed that they were forced to rely excessively on overtime hours and external agency staff. Now, as they build up their own internal staff, they no longer need to rely so heavily on external agencies.
Using the ZipRecruiter data, can I tell my college graduates what industries to look in? Where the biggest what do you get when you're a philosophy major? Ooh. What are they paying philosophers these days?
Right. So there are big differences across college majors. We have a college grad report that discusses these in some detail on our website. It is those STEM fields that are still getting graduates the biggest paychecks, computer science, and all the healthcare fields. Healthcare is showing unstoppable demand for workers. There are huge staffing shortages in many different occupations there. Physicians are retiring in huge numbers. We expect by the end of this decade that 40% will be over the age of 65. And that's creating huge opportunity all the way down. So nurses are moving up into becoming physician assistants and nurse practitioners. Hospitals are having to pull out all the stops to retain nurses. They're increasingly offering training programs for CNAs and less educated workers to enter those kinds of roles.
Julia, we only have about 20 seconds left. What's the top concern that employers have when you speak to them?
They are still worried that there could be a downturn ahead. They're worried that the U.S. consumer will be hit by these high interest rates on credit cards and auto loans, and they worry about the student loan debt resumption just around the corner.
All right, Julia Pollak, Chief U.S. Economist at ZipRecruiter, joining us to break down the latest jobs numbers.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
So this morning's jobs report, seeing employers adding 187,000 jobs in August. You also see the unemployment rate tick up to about 3.8%, but it had been hovering around 3.5%, about a half-century low for a while here. So I want to bring in Tom Gimbel, CEO of LaSalle Network, to break down some of these hiring trends and some of kind of a deep dive here within the data. Tom, thanks for joining John Tucker and myself this morning, especially on a slower Friday heading into the Labor Day weekend. What's your take when you are looking at some of these headline numbers? Because I know that the unemployment rate did climb a little bit to its highest level since last year, but is a lot of that due to more people just coming back into the labor force?
Yeah, absolutely. Participation rate increased a little bit, which is a good sign. And we had 187,000 jobs that were added, which is good. And you got to remember the prediction was 175,000. So we exceeded that. We're not over 200, but we are exceeding what the average jobs that were added between 2016 and 2020, which was 178,000 jobs on average. So it really signals it might not be the strongest economy we've seen in the past 3 years, but it's definitely not weak.
Now, I'm not going to give you an opening to do a commercial, but what does LaSalle Network do?
So we're a staffing and recruiting firm for white-collar jobs. So we do search for accountants, technology, sales, marketing, et cetera. And then we also have an interim or temporary staffing group placing people in those same fields. Okay.
Can you gauge for us how much they're getting paid, whether it's more the salaries are increasing or what? I'm trying to get a gauge of the inflationary components in all this.
Totally. Salaries over the past, during the pandemic, salaries increased the same way you saw it on the hourly side. with Target and Amazon getting up into $20 and $25 an hour. It happened in the same thing within supply chain and marketing and HR and accounting, and technology is always growing. And that continued really up until the end of last year. And then now we're sitting at a standpoint where it stabilized a little bit, where we've seen that the employee isn't in control the way they were in 2021 and 2022, where they could work when they wanted and demand whatever salary. And I think we see that by the labor force increasing and the unemployment rate going up, that companies are not in as much of a high demand as they were before.
What industries are seeing wage increases the most? I know you were talking about, obviously, technology and some others over the past year, but are there some less obvious particular groups there?
Well, I think it's really less about the industry and more about the roles. You could have somebody in technology that's working at a manufacturing company and they're going to get paid more. You could have a salesperson for a technology company being paid less because all the layoffs that exist. So I think it's really more about the individual roles of people than it is about sectors anymore. And that's usually what's happened since the Great Recession, is that it's been less industry. It's been industry agnostic when it comes to the recession, and more about the individuals and the roles that are in high demand. Cybersecurity continues to be super, super hot. You have healthcare that continues to be really, really hot, and people that are willing to do that, whether it be on the software and the technology side of healthcare. Remember 3 years ago, you couldn't find a nurse, pun intended, to save your life. And now we don't have that same problem. So things stabilize a lot quicker, and we just don't talk about that as much as we do when things are in short supply.
What are you seeing when it comes to sort of the work from home dynamic and some of the concessions that employers had been giving the past few years? Is there any sort of shift you're beginning to see happen here as obviously COVID begins to ease here?
Yeah, I think COVID has eased. I don't think that that's really the driver anymore. And what we're dealing with now is companies that are getting out front and leading. And I think what you'll see after Labor Day is more and more of companies that will be demanding people to come into the office 3 days a week and 4 days a week and the occasional 5. Now, there'll always be the outlier company that in order to recruit people will say, we'll let you work fully remote, but it's going to be few and far between. And I think on the big companies, you're going to see the majority of them, over 60 or 70%, they're going to have mandatory days in the office.
Is there a predictive capability to temporary help employment? What does it tell us about what businesses view of the economy?
Yeah, temporary help traditionally has been a leading indicator of when temporary wages and temporary staffing increases. It's companies putting their toe in the water following a recession or a slump in the economy, and that's how they bridge in. Now, what we've seen, there was an article in the Journal yesterday that said temporary staffing's lagging, which really lends itself to saying that the market's cooled down a little bit. I think it's really a different segment of that. I think that as unemployment and participation rates increase, that companies are able to find some people on their own a little bit more, a little easier. And that's an indicator. And we're seeing that people from the gig economy are now starting to re-enter the workforce. And the big one's going to be that we're still seeing, and I think this is an important indication, we're seeing temp to perm fees continue to be steady. And what that means is that companies bring in people to do temporary work, and then they'll pay money to buy out the agreement and bring them onto their payroll. And when that's happening, the economy's still strong because companies weren't planning to hire those people permanently, but they end up doing it. And that's a really strong indicator. And I still see those numbers as being on the strong side.
Hey, Tom, whenever you have particular economists who want to argue about a potential recession on the horizon in the next couple of quarters or just weakness in the economy, I mean, to your point earlier that you were alluding to, you still see that strength there. What do you tell them?
Well, I think the good thing about economists is they'll stick with their prediction, even if it goes for quarters and years, and then they'll eventually have it happen, and they'll say, I told you so, even though it was been going on for 3 years. And I think that's not real life. I think real life is that companies are hiring people. There's jobs for people that still don't have ideal backgrounds, which tells me it's still a strong economy. And it's not always about how much you pay somebody. It's, are people willing to do the work? And, we've gotten to a standpoint of entitlement in the country where we've got people that simply don't want to do jobs no matter what the dollar amount is. And that's where the disconnect is in our economic society. So I tell economists all the time, let's look at the companies that are hiring and the people that are taking the jobs and what the turnover and attrition rates are, and that'll tell you real things, but that's not captured in the BLS.
You talked about the sectors. What about the regions of the country? Who's doing what? Who's doing best and worst? And can you break that down?
Yeah, I think we're starting to see that, some of the policies and the regulations on the West Coast is really starting to affect some of that. And we've seen that, obviously, the moves of companies into Texas and Tennessee and other states. But we're seeing that if there's an area of the country where remote work is being offered more, it's coming out of California companies, because a lot of people don't want to pay the taxes and have the regulation there. So we're seeing a lot more remote work there. It's easier to fire and terminate people who aren't working in the state of California. And I think the coasts aren't as desirable as they once were, sans Florida. So we see a lot of uptick in Texas. We see a lot of it in Tennessee, which are, there's big growth areas in Austin and Nashville, and those tend to be really, really strong. And hiring in the South, the traditional, I call it the SEC South, from Alabama over to South Carolina, tends to be strong areas for small to medium-sized companies.
Tom, we only have about 30 seconds left. What's some of the top questions or concerns you hear from employers?
Oh, I think the biggest thing is, we're going into an election year. So there's less concern thinking that DC will want to have the economy humming going into it. But the biggest challenge that they're feeling is that of concern is if the overtime exemption salary is going to increase, what they're talking about, from 30, I think it's 38,000 to 54,000, and that'll be something that could really hurt if inflation doesn't settle down and having to pay overtime for people at entry-level jobs.
Tom, thanks so much for joining us. Always a pleasure. Tom Gimbel, CEO of LaSalle Network, breaking down what's happening with the jobs picture and hiring.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to get straight to our next guest, Eddie Vanderwalt of Bloomberg News. Eddie, we really appreciate your patience sticking with us this afternoon as we just heard from President Biden. I want to get your thoughts on his comments, as well as the labor market data this morning and the manufacturing data. Sort of what is your takeaway when he is talking about the resiliency here with the U.S. economy and the job market?
Yeah, absolutely. You know what? I think he probably has a reason to be satisfied with some of those numbers that came out today. The non-farm payrolls obviously came in above expectations and, in fact, above the prior month's revisions. Now, we did see the unemployment rate tick higher to 3.8%, but that's partly a reason, partly because people are coming back to the jobs market. We've got more people participating in the jobs market now. We saw the participation rate pick up. Subsequently to those numbers, we had the PMI numbers come in, which showed that manufacturing in the US actually slowed less than was expected. And that turned the markets around. We're now seeing, the S&P pretty much flat on the day. But I think the real action for me is in the bond market, where we're seeing a real steepening. We're seeing 30-year yields and 10-year yields rise by about 7 or 8 basis points, much more than at the front end of the curve. And what that tells us is that the markets are pricing out a little bit the recession risk. And of course, Biden will be very happy about that coming into an election next year.
I mean, talk to me about the bond market, though. I mean, earlier this week, the 2-year was above 5%. Was that the last we're going to see of that? Or do we think that there's a potential here to kind of reverse some of the movements that we've seen over the last couple of days?
Yeah, you know what, that the 2 years tried above 5% a couple of times and hasn't liked it. I don't think many in the market think that the Fed is going to raise rates much more. And really, the 2-year end of the curve is a bet on whether the Fed is going to be able to hike going into next year, or will be forced into hiking going into next year. And with inflation doing what it is doing at the moment, which is, coming down slow and steadily, not many people think that. The bigger risk, I think, for most economists is that the Fed will have to cut, that they will be forced into cutting because inflation slows, but at the same time the US goes into a recession. You're seeing the market, Main Street starting to shed jobs. But we're not seeing that at the moment. What we're seeing is that steepening, and we're sitting now with about 70 basis points of inversion between the 2-year and the 10-year points on the yield curve.
I want to get your thoughts on China, world's second largest economy here. I know there's concerns about some of its flagging growth, but is some of the disinflation that's happening, is that actually in favor of the Fed and maybe some other corners of the global markets here, as far as when you're looking at these other central banks that are still trying to fight inflation?
I think China has been an exporter of disinflation, right? I think the disinflation that we saw there is feeding through into goods that we buy here, and therefore also into services and also into wages. But I think it's wider than that, right? I think it's more worrying, because if China is slowing, that's because people across the world is not buying their goods, right? And if we're not buying their goods, that means that we're not spending money, and that's a recessionary flag. Now they've been slowly and steadily, they've been, people were hoping for this kind of big bang stimulus in China. Instead, they've been getting fairly small measures. But somebody in the newsroom said to me earlier today that maybe those small measures are starting to look like a machine gun, right? They're delivering them over and over and over. Every day that you come in, there's a little bit more stimulus. So maybe it's not a bazooka, maybe it's a machine gun, but the market's starting to pay attention. And we are starting to see, Chinese stocks doing slightly better. They still have a lot of trouble in their property sector, though.
Yeah, I mean, every day you come in, mortgage support here, tax breaks here, stocks support here. I mean, just very quickly, we only have about 20 seconds here, but do you see more of a risk that China contagion than the markets are pricing in? Just yes or no, please.
I think probably yes. I think if China slows down significantly, that's going to be a problem for the rest of the world.
Mm-hmm. Right. Well, world's second largest economy behind the U.S. and, of course, Japan, third largest economy. Eddie, thank you for being patient, sticking with us. We really appreciate it. Eddie Vanderwelt of Bloomberg News, of course, breaking down what we were seeing with obviously the jobs picture, and then on the back of those comments from President Joe Biden.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
When you are looking at what's happening with Amgen as well as Horizon. So Amgen can move forward with its around close to $28 billion takeover of Horizon Therapeutics after the FTC did say Friday that it accepted a binding settlement that the combined company would not bundle together two of Horizon's blockbuster drugs. I want to bring in Jennifer Rhee, Senior Litigation Analyst at Bloomberg Intelligence. She's always on top of all things when it comes to actually stories and deals like this, joining us to talk about this FTC settlement on this Amgen Horizon deal here. Jennifer, thanks for joining us this afternoon. Walk us through what this means moving forward with this deal.
Well, thanks for having me. I mean, I think this was a really smart move by the FTC, to be honest. They have sought a way to try to slow down consolidation, particularly in the pharmaceutical industry. And I think that they thought, this is a great opportunity with this merger to try out a novel theory, try to push the law out to make it easier to block pharmaceutical deals, and to try to go to court to get a judge to stop this deal using kind of a novel theory. And what that theory was that those two blockbuster drugs of Horizon that you just mentioned, one for chronic gout and the other for eye thyroid disease, would be in Amgen's hands. Amgen would be able to maintain the monopolies for those drugs because it would bundle it. and provide steep rebates for those bundles with other blockbuster drugs that Amgen already has. And it could do that better than Horizon could on its own, and it would block the future entry of other drugs. And here's the thing, that kind of theory could almost be used in almost any pharmaceutical deal. So it was kind of a big deal for the industry. So the fact that it's settling is also a big deal for the industry because it shows that the FTC kind of backed off that theory, which really is a broad theory.
Okay, but I'll dig into the details a little bit for me here. So the Tepeza and Krystexxa, apologies. How does bundling or an agreement not to bundle those drugs accomplish this purpose?
So the idea is that if Amgen provided really steep rebates, let's say to pharmacy benefit managers or insurers, to bundle those drugs, to put it on a drug formulary, what that would do would be to block out other potential up-and-coming new FDA-approved drugs that can compete with those two, with Krystexxa, I can't say it either, any other drug.
It's always a mouthful.
They always are. I don't know why they name drugs the way they do.
They really do.
But the idea is that if there are other innovators out there trying to come up with a drug or get FDA approval for a drug that could treat the same condition and potentially bring prices down across the board for drugs that treat those two conditions, that they really wouldn't be able to get into the market because these bundled rebates would be too enticing for the pharmacy benefit managers they'd have to accept them. And to accept them, they'd have to put the Horizon drugs on the formulary and not these competing drugs. And so the competing drugs can't get into the market. They can't get a foothold. So if Amgen can't bundle them, it opens up that avenue. It takes away that blockade, right? And it allows for the possibility down the road for other rivals to try to come in and compete against those two drugs.
Who do you consider to be the biggest rivals at this point for them?
I think that's the most speculative part of this entire lawsuit. They really couldn't really name any. I mean, now there may be in phase 3 or phase 2, somewhere along the FDA process, some rivals. Other analysts would be better off who know what's going on in the biotech space to speak about that. But here's the thing. It was so speculative because the FTC couldn't really say, hey, X drug or Y drug or ABC company has something coming soon. They couldn't do that. It was really speculative that maybe down the road, maybe there will be something that might compete and might not be able to. So it was a tough theory for the FTC to try to win in court. And that's why I say that it was probably a smart thing for them to do to get this settlement instead.
Yeah, I mean, also, what do you think that this says about the broader FTC task here? We had Black Knight, ICE, dropping the challenge there yesterday.
Right.
As the FTC's realized that it's run up against a wall?
I sort of think it has. I think the FTC got a little bit tired of losing. They lost 2 big merger challenges that were really well publicized. That was a challenge to Meta trying to buy a small virtual reality company called Within, and then Microsoft trying to buy Activision. These were really well known, sort of spectacularly public court losses. And I think that they pulled back a little bit. They have been very aggressive. I think they do want to continue to be aggressive, but maybe they pull back to think about, look, we can be aggressive, but maybe we need to pick and choose our challenges to deal just with a little bit more discretion, because when we go into court with a really tough theory, particularly if you don't have the evidence and the facts to back that new theory that you're asking a judge to accept, there's a good chance we're headed for a loss, and we need to get a win down the road. So yeah, I think it probably shows that the FTC is going to exercise a little more caution going forward with respect to challenging specific types of deals.
Jennifer Rhee, Senior Litigation Analyst at Bloomberg Intelligence, thank you so much for joining us.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.